Kia ora and greetings from being green, New Zealand. I'm going to talk about the financial system today, the fractional reserve banking system. And I'm going to do it in terms of geometry because it's easier to understand it in the geometric shapes than it is by just considering the numbers, which can just be seen as confusing digits on a screen. The geometry is a much easier way to understand it. Now, acknowledging that the banking system includes elements of light and dark, I'm going to say a karakia, it's a Maori karakia, beforehand, just to ensure that the space is good to be talking about it. I tōku waroa, I tōku aho no te atua, I tōku aroha, I tōku hia, I tōku mātua amu. Now, this is really an image of the fractional reserve banking system and the potential of it. Broadly, on your right, you've got debt. This entire dark portion here, which is the dark side of it, and on here, broadly, including the sliver of orange, you have credit, which is the light side, broadly, of this tree, which is comprised of light and dark, credit and debt. Now, basically, what happens in the fractional reserve banking system is that you put money into it as a deposit, and a fraction of that, which is where the name comes from, a fraction of that, 10% typically, is held by the banks on reserve. Now, they can lend out 90% of your money as debt to other people. So basically, when you make a deposit, it's going to take a portion of this pattern on the right-hand side. When you make a deposit, 90% of it is deposited or is lent out as debt, and 10% of it is stashed away as in the bank's reserves, and the rest isn't really here. Actually, this is empty, this space, but it's showing as a balance on your statements, etc. Alright, so look, here are actually some numbers. On your left-hand side here, so the credit side, and you've got the debt side on the other side. You deposit $100 as credit, $90 would be lent out as debt to someone else. $10 would come down here and be put in the bank reserve. Of that $90 which has been lent out, it's all deposited when someone spends it, and then it goes in as another deposit, and at this point 10% of it, which is $9, gets put in the bank reserve, and $81 of it gets lent out. That $81 is deposited, etc. $8.1 in the bank reserve, and then $72.9 of that is lent out. This carries on to ever decreasing numbers. Roughly, it can go through the banking system 10 times. Now, after this has grown by about 10 times in all areas, the system starts to actually slow down. Now, that can be expressed in this sheet by it almost saturating through the potential of its growth. It means that all of the money in circulation is kind of reaching the top of this tree, and you then reach the situation that we're in now, which is a liquidity gridlock, a non-liquidity gridlock. That's a phrase that's been thrown around in the media recently. It just means that the tree, as it's designed, its growth is slowing down, and it can't really grow effectively anymore to match the growth of the economy, the global economy, because this is a global financial system. So what happens when you get to the top of this money tree, when it's almost grown to its full limits, although it'll never actually fully reach its full limit because of the infinitesimal factor? What happens is you end up with more debt in general circulation than there is credit in general circulation. This is in public circulation. And that is because the banks have been slicing off an amount of the credit balance to stick away in their reserves. So you end up with a situation where you have more debt in circulation than credit. This means that the available credit in the whole of the system literally cannot service the amount of debt in the whole of the system. It is untenable, it is inequitable, and that is because of this amount here, which has been stashed away. Now this 10% has been stashed away for a particular reason by the banks. They call it a safeguard. It's a safety cushion in case people are taking out slightly more money out of their credit accounts than people are repaying their debts. Now, when your economy is all ticking along real nice and smooth, that doesn't happen very often. It'd be a blip. But when you start to go into a financial meltdown, when the whole system is saturated and there's not enough credit to service the debt, at that point people start taking their money out beyond this 10% buffer, and you're then into situations of bankruptcy, which I'll get onto in a minute. Hello, I'm making an insert into this video the day after I filmed the main body of it. The reason I'm doing this is because I would like to clarify something about this sliver here, the reserve. It in itself does not actually deprive the credit side of credit, but what it does do is it allows this finite shape. It allows the money to grow to pretty much a finite amount. It's never going to quite reach it because it's getting there closer infinitesimally, but by stashing this sliver away, it provides the finite shape, and then you're down to the proportions of what actually happens between the credit side and the debt side, and the growth of the debt happens faster because interest rates are higher for the debt side. So when you end up with more debt in circulation than credit, it's broadly happened because there's a higher interest rate applied to debt than there is to credit, but it becomes apparent and a problem because the whole tree has slowed down due to the deprivation of this sliver here, which has been tucked away behind the bank's backs. Just thought I'd clarify that for you guys. Cheers.